I've got big news about one of the lenders we track, and it's a doozy. A bombshell lawsuit claims that OneMain is exploiting borrowers to the tune of millions of dollars. OneMain Financial says yes to people with poor credit when big banks say no. But right now, 13 state attorneys general have filed suit against them. What's it all about? We'll get into it. In March 2026, a bipartisan lawsuit spanning 13 states was filed claiming that OneMain engaged in a systematic loan packing scheme. The lawsuit accuses OneMain of quietly adding hundreds of dollars in charges to borrowers' loans without them even knowing it. And the number that got me? The average borrower was hit with $826 in charges they didn't ask for. Yes, $826. That's the average. That means there are a lot of customers who were hit by bigger charges. According to the complaint, OneMain is ambushing its customers. Today, we're breaking down exactly how the states claim OneMain is doing this, how the company is defending itself, and most importantly, the red flags you need to watch out for to protect your financial life. So here's the quick background. OneMain Financial is one of the biggest personal lenders in the country. They operate over 1,300 branches across 44 states. Their whole pitch is, we give loans to people who can't get them at a traditional bank, which sounds great until you look at what some of those loans actually included. The core of the lawsuit is an add-on packing scheme. The states claim that OneMain markets itself as a provider of clear, upfront loans, but then pushes additional unnecessary products during the closing process, sometimes without the customer's knowledge. How did the extra charges end up on a loan? And what were these add-on products? OneMain sells things like credit life insurance, credit disability insurance, roadside assistance membership, and something called Silver Safeguard. These products are supposed to step in and pay the loan off if the borrower loses their job, dies, or gets hit by unexpected events. In some of our past videos, we've warned that these products are overpriced and rarely pay claims out. And now we know why. In many cases, people don't even know they were signing up for them. Even if the product is valuable, it's hard to file a claim against them if you didn't even know you had it. How the lawsuit claims OneMain snuck these products into people's loan agreements is as simple as it is devious. The states claim OneMain preloads these add-ons into an applicant's loan document before they even discuss it. It would be like the grocery store deciding upfront what you are going to buy before you even walk in the door. It doesn't matter that you think herbal tea is dog water. It's in your cart. You need to buy it. Then the employees would scroll through the documents themselves, often on a small screen like a phone or an iPad. The applicant isn't directly in control of the device, so they can feel steamrolled through the process. The complaint says that the fine print was buried inside loan documents that could be 50 pages of legalese. Imagine reviewing 50 pages of a legal document on a device this small when you're not even holding it. The lawsuit claims that OneMain's corporate offices incentivized branch employees to sell these products by offering commissions and gift cards. But even worse, the company instructed employees to ignore when the customer says no up to 3 times before removing the add-on. They had incentives, they had training, and they had pressure. What does this look like in practice? Well, one borrower in the lawsuit refinanced a $2,700 loan. They got $2,730 in new cash. But OneMain added $1,674 in insurance premiums and then charged interest on top of those premiums. So the person was paying for fees they didn't knowingly buy and then was charged interest on those fees. OneMain was able to look like their loans were significantly cheaper than other subprime competitors because none of the add-on fees are counted in the APR. So when borrowers compared the APRs of different loans, OneMain looked like the best option. The borrower had no way of knowing that the cost of the loan could double or triple after the fees are snuck into the loan agreement. And this is where things could have been especially deceptive. By law, all unavoidable fees must be included in the APR. OneMain was claiming all of these fees are optional and so don't need to be disclosed in the same way. So here's the trick. By labeling these products optional, OneMain could keep them out of the APR calculation entirely. But the lawsuit argues that they weren't really optional at all. It says that employees often implied the additional products were required to gain approval. And if these products were built into the loan agreement up front, It sure seemed like they were required. Customers might have thought that they were getting a 27% APR loan, but the cost ended up being something closer to a 60% APR loan. It's like buying a car for $20,000 without realizing that the dealer added $10,000 in air fresheners and extra floor mats while you weren't looking. And here's the kicker. This is the second time in 3 years regulators have had to step in. In 2023, the CFPB, that's the Federal Consumer Watchdog, fined OneMain $20 million for basically the same thing. The fact that 13 states are back in court in 2026, it tells you something about how much things have actually changed. Now, before you write them off entirely, let's hear what OneMain has to say about the lawsuit. OneMain's statement is pretty direct. They say, and I'm quoting here, "The state's allegations are simply untrue. Their argument is that this was already reviewed by the CFPB and fully resolved. They say they operate honestly, they're in full compliance, and they plan to fight this in court." And that's actually a really good legal argument. Their defense is going to be, we already settled this. We already paid. They will also argue that they made changes to their processes based on the consent order. So coming back to this is double jeopardy in everything but name. They'll also argue that borrowers signed documents, even complicated ones, and courts have historically been pretty reluctant to undo signed contracts just because the fine print was hard to read. So this is not a slam dunk case. It's going to be a fight. We should figure out how to protect ourselves regardless of what happens in court. So let's talk about what we should do. If you have or had a OneMain loan, pull up your loan document and look for anything labeled credit insurance, gap coverage, home and auto plus, or silver safeguard. If you see charges that you didn't agree to buy, file a complaint with the CFPB and file one with your state attorney general's office too. Those complaints will directly affect how much money OneMain will need to cough up if they lose or settle the case. If you're shopping for a personal loan right now, here's your playbook. 1. Demand an itemized breakdown of everything in your loan before you pick up the pen. Not a summary, everything. And if you see anything in there that you don't want, demand a clean quote. Ask for the monthly payment and total cost of the loan without any insurance or club membership fees. These products are almost always optional. And if they are required, they have to be included in the stated APR, which means that the APR will be significantly higher than the interest rate. 2. Know that all add-ons are optional. If anyone implies that they're required for approval, that's a huge red flag. If the loan officer strongly encourages you to take an insurance product, push back. Ask them, out of every dollar people pay into this insurance, how much actually gets paid out in claims? Insurance companies call that the loss ratio, and it should be around 70 or 80%. Anything significantly lower than that is a huge red flag. 3. Look beyond the monthly payment. Look at the total amount you're borrowing. If it's higher than the cash you're receiving, you're paying for add-ons. The monthly payment can look totally fine while the total cost of the loan is quite enormous. Ask the loan officer to break down the total monthly obligation. How much will go towards principal, and how much will go towards interest, and how much will go towards other fees. If it doesn't all add up like you were expecting, you're probably paying for hidden add-ons. 4, and this is really the most important point, you always have walk-away power. If they keep pushing you after you've said no, or they can't answer all of your questions, leave. Don't try to fix your financial emergency with a loan that might leave you in a worse situation. There are other lenders in the subprime space who are more transparent. 5, you have the right to understand every line of what you're signing. Don't let a company bully you with the legalese that they know or hope you won't read, especially if the contract feels unnecessarily large for the transaction. If you're borrowing $2,000 and the agreement requires you to read and sign more pages than a mortgage, that's probably a red flag. If doing all this seems a little too much, then OneMain is probably not the lender for you, even if they show a better interest rate. Look, the point isn't to scare you away from personal loans. Sometimes they're the right tool. The point is you have to know what you're signing. If you ever feel out of control, step away from a transaction. If this was helpful, share it with someone who's thinking about borrowing money right now. I'll link the full complaint and the CFPB filing page in the description below. And if you want more information about OneMain's personal loans, check out our most recent video review. Don't forget to like this video, and thanks for your support. We appreciate it. Thanks for watching.